Hello again, everyone, and welcome back to Virginia International University's MBA 636 Managerial Accounting course. Today we're going to be talking about Chapter 8, which really deals with short-term decision-making and how we factor relevant costs and what we know about cost behavior to make special business decisions. These are short-term business decisions, so we won't need to discuss time value of money concepts. So in this first section, what we want to do is to talk about, to describe and identify these short-term business decisions and the information that's relative to them. So one, it's kind of good, and we always talk about making decisions, but it is a good idea to think through what is our strategy for decision making, right? And so that we can kind of create a model or a framework to think about a problem. So first we want to define what our business goals are. We'll identify the alternative courses of action. So what do we have available to us to pursue? We want to gather and analyze the relevant information, choose our best alternative, then implement the decision, and then we want to always go back and follow up and compare actual with anticipated results. I think all too often we make decisions, we assume they're good, and we just move on to the next decision. We have so much to do, our days are so full that we really don't have the opportunity to sit back down and reflect and think whether or not, given what the outcomes are, did we achieve what we expected to achieve, so that perhaps if we have to make the same decision again, we've learned from it. So again, this is just kind of a model or a framework. Everybody makes decisions their own way, but it's always good to be able to make them in some context and following some framework so we don't rush through the process. So when we're talking about relevant and irrelevant information, relevant information is we should be considering expected future cost and revenue data, not costs incurred in the past. And we talked earlier about what those costs are. They're sunk costs, right? And they don't really have anything to do with our current decision-making process. It's relevant information because it's information that affects your decision. So it should also differ among alternative courses of actions, and it's important to know that relevant information includes both quantitative and qualitative factors. Irrelevant information is costs that do not differ between alternatives. So, if I have a cost element and it's the exact same amount for one alternative versus another alternative, I don't have to consider that in my decision-making process because it's not going to have any impact on the ultimate outcome. And then we also talked about this sunk costs, which were incurred in the past and cannot be changed regardless of which future action we take. So we don't consider sunk costs, and we think of them as being irrelevant to our decision making. And a good example of a sunk cost would be, suppose I'm looking at and going into a product line, and I commission a market study to tell me about what's the market, what's the growth rate, what's my potential fit with it, what might I get as a market share, just all kinds of information associated to the market that I'm interested in pursuing. Well, once I decide about pursuing that market, I might have to decide, well, which product do I want to pursue in that market, or how do I want to position myself in that market, and when I'm making those decisions, I don't use the cost of the market study in my decision making, because no matter what decision I make, I won't get back that cost that's already been spent. And so that's a good example of the idea of sunk cost. And so then we look at this relevant non-financial information, right? And so these we also think about as qualitative factors, and they also should play a role in the manager's decision. And they may include decisions like laying off employees, outsourcing, which result in reduced control over delivery time and product quality, or discounted prices to selected customers, right? We think that managers who ignore qualitative factors can make serious mistakes. So don't ever look at something just from a quantitative perspective, because from experience I can tell you there are often much more important qualitative factors that would point us down a path very different than where we might go based on quantitative solely. So in this section we're going to talk about 6 short-term special decisions. That's special sales orders, pricing, discontinuing products, departments, or stores, products mix decisions, outsourcing decisions, and then this idea of selling a product as it is or processing it further and then selling it. And so there are some keys to making short-term special decisions, right? And one of them is the decision approach. That is that we not look at this from the perspective of the entire income statement. We just look at how this decision is going to impact our operating income, or how our operating income would differ under each alternative, right? And we think of that as far as the relevant information approach or incremental analysis approach. Right? And then we talked that there are two keys in analyzing short-term business decisions. One is the focus on relevant revenues, cost, and profit. And then with that, we use the contribution margin approach that separates variable costs from fixed costs. And we know that that's important from prior discussions because these costs behave differently. And then we also, want to just briefly touch on the fact that short-term decisions, we view every decision that has an impact on people, planet, and profitability, right? And so Timberland is a good example of this, where they consider themselves to be doing well and good, and as an example, they give employees PTO to volunteer, right? But again, some of these decisions are costly, but yet in the end, at the end of the day, if they had an impact on this idea of people, planet, and profitability from a sustainability perspective, then they maybe have been well worth the sacrifice. So the first special decision we want to talk about is to decide whether to accept a special order, right? It's special because they generally are thought of as being one-time deals. So our special order considerations say that if a customer requests a one-time order at a reduced sale price, often for a large quantity, we have to look at remember, qualitative and quantitative decisions. So the first decision rule is, do we have excess capacity available to fill the order, right? So that means, are we not producing at 100% and selling at 100%, or do we have the capability and the resource in our process to produce extra capacity to fill the order? If yes, we might consider it further. If no, we'll reject the special order, because why would we give a customer a price break, to be frank about it? Why would we offer a price break if we're making and selling all that we can make and sell right now? The next decision rule says that, is the special order reduced sales price high enough to cover the incremental cost of filling the order, right? And there we're looking at, well, am I going to cover my variable costs, right? Because if I'm not going to cover my variable costs associated with the order, then, unless there's a strategic case that can be made for it, I'm not going to do that. So if revenues are greater than the expected cost increase, which generally are going to be variable cost, then we would accept the special order. If they're less than the expected cost increase, we would reject the special order. And then the final decision rule would be, will the special order affect regular sales in the long run? And so these again become a qualitative issue. So what happens if some of my other customers find out I provided the same product to a competitor of theirs at a reduced rate? So would they then demand that reduced rate on theirs, on their orders, or would they demand one-time pricing concessions on their orders? So this is an example of a qualitative issue that will come up. And so again, will the special order affect regular sales in the long run? If no, we'll accept the special order, and if yes, we reject the special order. So these are some of the decision rules that come into effect when we are looking at special order decisions. And so for objective 3, we want to describe and apply different approaches to pricing, right? So now I'm going to set the price for what I sell, and how might I go about doing that? And so there are a couple considerations with respect to regular pricing decisions. What is our target profit, right? So maybe we have venture capitalists who are requiring a certain return, or maybe we have investors who require a certain return, which means we have to generate a particular target market to meet that expectation. Then we also would say, how much are our customers willing to pay? And that becomes a function of competition. What are our competitors selling their product for? Product uniqueness. How different is our product from theirs, and how much better can we make the case that our product is from there? The effectiveness of our marketing campaign, right? So are we able to distinguish and differentiate ourselves so that customers are willing to pay a premium for our product versus that of our competitors? And then general economic conditions. And then the question becomes, when are we a price taker or a price setter? And I'm sure you all have dealt with this in your marketing class, but if we're price takers, the market sets the price and we have to accept it. We're not able to build a premium into our price because the price is set by the market. Or we're a price setter, which says we use a methodology for setting our price, and this is the price that it's sold at on the market. As you can imagine, the answers to all of these questions are complex and ever-changing, but again, we have to be sure that we take into account the qualitative and quantitative factors associated with them. So this just provides us with some of the differences between price takers and price setters, right? So a price taker has very little or no control over the price versus a price setter who, through one methodology or another, is able to set the price. So with price takers, their product lacks uniqueness versus having a more unique product for price setters. For price takers, there's heavy competition, and so we have to be very careful with respect to how we set our price, lest we lose market share to competitors. We have less competition where we're price setters, and so we have, again, more control over the price. And then with price takers, the pricing approach emphasizes target costing, so we try to impact the cost the cost to us of manufacturing or providing the service to increase our profit, versus a price setter pricing approach which emphasizes cost plus pricing, where we're saying, hey, this is what it costs me to make the product, and so when I tack on my desired profit, this is what the price will be. So you can see there are very fundamental differences between being a price taker and a price setter. And so this is an example with respect to target costing from Exhibit 8-9. So market price minus desired profit equals our target cost, right? Or another way to look at it is my cost plus my profit equals what my market price would be. My target cost has to include costs such as development costs, marketing costs, delivery, service, production, design, right? I have to factor all of these costs into what my cost is. And if I'm not able to do that, then I'm not recovering all of my costs, and a serious decision needs to be made about whether or not I'm going to participate in that market. And so here are just some calculations based on this process of setting a price using a target costing approach, which means really we're a price taker. We look at what the market is, and we say, well, the units in this case are selling at $3 each, and we expect to be able to sell 250,000 units. So we expect to have total revenue of $750,000. We expect our desired profit to be 10%, and we're assuming from Exhibit 8-9 that we have $1 million in assets, and we want a 10% return on our assets, which is a very fair way to look at this. What do my investors want for their investment? And so we reduce the $750,000 in revenue by the desired profit associated with the assets it takes to generate that $750,000 to get us to a target total cost of $650,000. And so essentially what we're saying there is that I have to be able to cover all of these target cost items that are identified above there, development, design, production, and so on, in my $650,000, or I'm going to impact the desired profit. And so again, we're looking at setting it, being a price taker, and managing our product from the perspective of how do we better control the cost it takes to manufacture the product versus changing the price, since we have little control. So we have a couple of different outcomes when using target costing. So if the actual cost is less than the target total cost, then it's okay to proceed with the product line, right? Because we can make it for less than what our target total cost is, and when we add the profit onto that, we'll be able to add even more desired profit onto that to reach the price the market sells in at the market, so we should proceed. If our actual costs are greater than our target cost, then we have a couple of options to us, right? We can seek to lower our price, we can cut fixed cost, we can cut variable cost, or we can have other strategies like increase sales volume, change or add to our product mix, or try to differentiate our product. But we are in a bind here where our actual cost is greater than the total target total cost, because what that means is that without some of these cost efficiencies, we're going to cut into how much profit we make, and that may be unacceptable to investors. And then some of our other strategies that we talked about where our actual cost is greater are to increase sales. And here we can use our CVP analysis to compute total sales to achieve our target profit. And I hope you all remember from Chapter 7 how we do that. We can look at changing or adding to the company product mix. And so that's offer levels of the same product, right? So maybe I want to build, I offer a basic and a premium model or version of something. I offer new items to the product mix with a high contribution margin, or I remove items with the lowest contribution margin, assuming that I'm able to also eliminate the fixed cost associated with that. And then we also could go down this path where we differentiate our products and try to make it unique through actions like branding or quality or service packs. And again, this is a way of convincing the market, or trying to convince the market that they should be willing to pay more than what they're currently paying for our product or for a product like ours. And so again, these are just other strategies in the case where we are price takers. Okay. So now let's talk a little bit where we're price setters. So this is the opposite of the target pricing approach. And for cost plus pricing, we start with the company's full cost, and then we add the desired profit to determine a cost plus price. So in this situation, as you can see, we're starting first with what does it cost us, then what profit do we desire to get to the price that we're going to put it on the market at, which is the exact reverse of where we were when we were a price taker, right? But we still have to be careful that the price that we set is something that customers are willing to pay. And so we start total cost plus desired profit gives us the cost plus price. And so here's an example of calculating a cost plus price from Exhibit 8.12. So we start with our current variable costs, and we're given that they're $250,000 units at $1.50 per unit. So we know that our variable costs are going to be $375,000. We're given that our current fixed costs are $325,000. So our current total costs are $700,000. Again, we want to earn 10% of the $1 million of assets that it takes to generate this product. So we want to earn $100,000 to give us target revenue of $800,000 divided by the 250,000 units that we can manufacture and sell, so which gives us a cost plus price per unit of $3.20. And so the question becomes one, is the current price is $3, can the company charge $3.20? Can we differentiate our product or our brand? And one way in order to charge this premium, right? And one way to do this would be to use focus groups to help us design our strategy around this. So again, we look at this, and this is a very different way than when we were a price taker, right? So for pricing decisions, the rule is how to approach pricing. So if we're price takers, we have to emphasize target costing. If we're price takers, we have to be worried about, well, this is the price we're able to sell it at. Can we manufacture it for a cost after we've taken out of that our desired profit? If we're a price setter, we emphasize cost plus pricing approach, and that says, well, here's what it cost us to make the product, and when we tack on the profit we desire, we end up getting a price. how does that price compare to the price in the marketplace? And do we have to do something else perhaps to convince customers that some particular premium is desired? And so then we go with our short-term decision again, and here we're talking about the decision whether to discontinue a product or a department or a store. And so these business decisions include when to discontinue a product, department, or store, how to factor constrained resources into product mix decisions, when to make a product or when to outsource it, and when to sell the product as is or process it further. So this is just an example of the considerations for discontinuing a product. And remember, there are two key guidelines. We want to focus on relevant data, and we want to use the contribution margin approach. And the first question that we have to ask is, does the product provide positive contribution margin? So that is, does it provide some sort of coverage of fixed cost, right? And so if we're looking at discontinuing perhaps air cleaners, we can see each of the company total is 312,500 units. That's composed of oil filters and air cleaners, right? So oil filters, from a contribution margin perspective, provide $425,000 toward covering fixed cost. The air cleaners provide $50,000 toward covering fixed cost. By the time we factor in what our fixed manufacturing overhead and then fixed marketing and administrative costs are, we're still positive operating income for the oil filters of $165,000, but we're losing $15,000 in net income on the air cleaners. And so a couple of questions come to mind then is, well, if we discontinue air cleaners, will we be able to use that capacity to produce more oil filters? So do we have the demand for more oil filters? If we discontinue air cleaners, will we have will some of this fixed manufacturing overhead and fixed marketing and administrative costs go away, or are they going to be incurred at the same level and have to be absorbed by the oil filter products? And so you can see there are several different decision variables that come into this and questions where we need to gather additional data. And so we talk about what are some of the considerations for discontinuing products or stores. We talk, will the total fixed cost continue to exist even if the product line is discontinued? And if that's the case, well, we could see in our prior example that we at least covered $50,000 toward that, toward covering those fixed costs. And if they're going to continue to exist, what are we going to do to generate at least $50,000 we've lost by discontinuing that to go toward covering these continuing to exist costs? Can any direct fixed cost of the product be avoided if the product line is discontinued, right? So, we discontinue it and part of the fixed costs, if not all of them, go away. And then, can any direct fixed cost of the product be avoided if the product line is discontinued? And then use incremental analysis for discontinuing a product. So with respect to discontinuing products, departments, or stores, the decision rule is to discontinue a product, department, or a store if lost revenues from discontinuing a product, department, or a store exceed the cost savings from discontinuing. Do not discontinue. Right? If total cost savings exceed the lost revenues from discontinuing a product, department, or store, then we want to discontinue. So those are the decision rules when we talk about discontinuing a product or a store. So now we want to talk a little bit about how to factor resource constraints into product mix decisions. So let's first look at the product mix considerations example in page 477. So here we have an organization or a company that manufactures jeans and t-shirts. And we see the sales price of jeans is $30. The variable expenses related, the sales price of shirts is $30. The variable expenses related to shirts are $12 to generate a contribution margin of $18 per shirt, right? Then we have the contribution margin ratio then for product A is our $18 divided by $30, right, or 60%. Then let's talk about our jeans. So the sales price for jeans is $60, the variable expenses are $48, and the contribution margin is $12. Our contribution margin ratio for product B, the jeans, is the $12 contribution per unit, the $12 contribution margin per unit of $12 divided by the $60 to get us to the contribution margin ratio of 20%, right? And so under this scenario, if we see that the units, we see that first we look at units that can be produced per machine. So we can produce 10 units, per machine hour. So we can produce 10 shirts with 1 machine hour, or we can produce 20 jeans with 1 machine hour. And so the contribution margin per unit is going to be, for shirts, the $18 contribution margin we just calculated, right, times the 10 shirts. So per machine hour, we're generating a $180 contribution margin versus a $240 contribution margin per machine hour for jeans. The available capacity, or the number of machine hours, is 2,000, right? So we have 4,000 in total. So we have 2,000 by shirts multiplied by the contribution margin per machine hour. We are generating 360,000 total contribution margin at full capacity. If we have 2,000 machine hours applied to the jeans, we're going to generate $480,000 in contribution margin. So to figure out which product should we emphasize, we should ask, would emphasizing one product over another affect the fixed cost? Would constraints stop us from making or displaying all of the units we could sell? And then what products offer the highest contribution margin per unit of constraint? And so in this case, the machine hours are a constraint, right? So here we have our question for product mixes, which product to emphasize, and the answer is to emphasize the product with the highest contribution margin per unit of constraint. And so for this objective, we're analyzing our outsourcing or make-buy decisions. And I'm sure that you all know from your studies and from your experience that these decisions are becoming more and more frequent with the increasing globalization of operations. And so even companies that, 20 years ago would have never thought of outsourcing are now able to give that more serious consideration. And so when we are looking at outsourcing make-buy considerations, there are a couple of things we have to keep in mind. So first, it involves buying a product or service or producing it in-house. So are we going to buy it from someone, or are we going to produce it? Now, sometimes that may be someone around the corner. Sometimes it may be someone on the other side of the world. But at the heart of these decisions are how best to use our available resources. So in looking at this decision, we want to think about how do our variable costs compare to the outsourcing cost, right? And if our variable costs are less than what an outsourcer's variable cost may be, then essentially it's going to cost us more to buy that from a contribution margin perspective, and we need to take that into consideration. We want to know if there are any fixed costs avoidable if we outsource. So can we reduce fixed costs if we outsource this and shift that leveraging, that operating leverage to our outsourced supplier? And then what could we do with the free capacity, right? So if we end up outsourcing something that was manufactured in our plant, which means we either don't need a line of equipment and don't need a particular place in our plant to do that now, what are we going to do with that? What are the opportunity costs associated with that space? So you can see these are often can be very complex and important decisions. So the decision rule is, should the company outsource, right? And what the criteria are that if the incremental cost of making exceed the incremental cost of outsourcing, then we want to outsource, right? Because we can buy it cheaper. If the incremental cost of making are less than the incremental cost of outsourcing, then we do not want to outsource, right? But we focus on relevant data again, and we use the contribution margin approach in getting to these solutions. Okay, and so finally we talk about the last decision we're going to talk about, and that's make sell as is or process further. And we see that a lot with like food processing companies or natural resource companies where we get to a point to where in processing the product we're able to sell it as is, or we can make the decision to spend more time and spend more effort and resource in getting it to another state and selling it at that state. So the decision becomes one of, well, at which state do we sell it? And so there are some considerations that we need to take into account, right? So how much revenue is generated if we sell the product as is? We don't incur that additional cost and we simply sell it as is. How much revenue is generated if we sell the product after processing it further? And then we want to understand how much will it cost us to process the product further, so we're generating additional revenue, but we also want to make sure that that additional revenue we generate isn't exceeded or surpassed by the additional cost it takes to process it further to the point that we can get the additional revenue, right? And so this is an example of a make or buy decision, right? I'm sorry, not make or buy, but a sell as is or process further decision, and it's Exhibit 8-25. So again, we're using incremental analysis here. So our expected revenue from selling 50,000 quarts of regular olive oil at $5 a quart, if we sell it as is $250,000, right? And so we would benefit by $250,000 to sell as is, right? However, we can also process that olive oil further, and we would get expected revenue from selling 50,000 quarts of gourmet dipping oil at $7 or $2 more per gallon. So we would generate revenue if we process it further of $350,000, but that would be offset by the additional cost of 75 cents per quart to convert 50,000 quarts of palm oil of plain olive oil into gourmet dipping oil. So it's going to cost us 75 cents more per quart to process further, which results in a cost of $37,500. And so the benefit under processing further would be $312. So we use this incremental analysis approach, which is our last column there, to say that, well, if we processed it further, we would sell it for $100,000 less the 37. We would generate an additional $100,000 in revenue. We would also generate an additional $37,500 in cost, so that the total net benefit of processing and selling it further as gourmet dipping oil rather than olive oil is $62,500 that would go toward covering our fixed cost. And so in the example, we're also told that we spent $100,000 getting the product to the point of being olive oil, and you'll notice we ignored that here because that's a sunk cost. Nothing we do here is going to impact our it was the same cost to get it to the olive oil, and we started from the olive oil and added additional cost to process it further. So we ignore that $100,000 in sunk cost. And so then with respect to sell as is or process further, the decision rule, we say that if the extra revenue from processing further exceeds the extra cost of processing further, we want to process it further. And in our previous case that we looked at on the last slide, we generated $100,000 as a result of processing the olive oil further to gourmet dipping oil, and the cost associated with that was $37,500. So, at the end of the day, we were $62,500 better off versus the extra revenue that we generate from processing further that could be less than the extra cost of processing further. And in that case, then we would not process further, and we would simply sell as is. And so there again, now we end Chapter 8, and please don't hesitate to send me any questions, or if anything isn't clear, you'd like more information or to discuss further, and please don't let this listening to this video substitute as a substitute for reading the chapter. And I look forward to talking with you again soon and on Chapter 9. Thank you.